Today, we're breaking down FTXO, the first trust Nasdaq Bank ETF, a fund designed to give investors targeted exposure to some of the most liquid and influential banking companies in the United States, but with a factor-driven approach that sets it apart from traditional bank ETFs. FTXO tracks an index composed of 30 highly liquid U.S. banking stocks. These are companies heavily involved in core banking activities like retail banking, lending, financial transactions, and broader financial services. Instead of simply weighting these companies by market capitalization like many traditional ETFs, FTXO uses a multi-factor strategy to determine both which banks are included and how heavily they are weighted in the portfolio. The index ranks eligible banks using three main factors: volatility, value, and growth. Volatility is measured by the stock's trailing one-year price movement, helping the index understand how stable or unstable the stock has been. Value is measured using cash flow relative to price, which helps identify banks that may be generating strong cash flow compared to their market valuation. Growth is measured through price momentum, analyzing the stock's average performance over the previous 3, 6, 9, and 12 months. Each bank receives a combined score based on these factors, and the ETF then weights the holdings according to those scores. That means companies demonstrating strong momentum, attractive valuation metrics, and manageable volatility may receive higher allocations within the fund. However, diversification is still maintained. No individual holding is allowed to exceed 8% of the total portfolio, preventing the ETF from becoming overly concentrated in any single bank. The ETF focuses specifically on the 30 most liquid banking stocks in the U.S., typically including major national banks and large regional lenders that play important roles in the American financial system. Because liquidity is a key requirement, the companies included tend to have strong trading volume and broad market participation. FTXO's index is reconstituted once per year, meaning the list of eligible banking companies is refreshed annually. The portfolio is also rebalanced quarterly, so the factor scores can be updated and weightings can adjust based on changes in valuation, volatility, and momentum. This process helps keep the ETF aligned with the strategy's factor-driven approach, rather than simply tracking the largest banks by size. For investors looking for targeted exposure to the U.S. banking sector, while incorporating factors like value, growth, and volatility into the selection process, FTXO offers a more strategic alternative to traditional bank ETFs. But like all sector-focused funds, investors should remember that performance will still be heavily tied to the health of the banking industry and broader economic conditions. If you want more ETF breakdowns like this one, make sure to like, subscribe, and check out the rest of the channel where we analyze ETFs across every sector of the market.